Good morning, everyone. Welcome to our Monday morning trading session. Hang on here 1 second. I'm going to get you my monitor. A little bit of a soft open to the markets this morning. They didn't really do a whole lot from Friday's session. You can see here's the eagle on the NASDAQ, and we left off, well, right here around 47.20, more or less. A little bit of a rally through the overnight, then the market started going sideways, and here we are again around this whole 47.20 area. We might have to give the market a few minutes here to get its bearings, but at the moment things are still a little bit more bullish than bearish, I would say. Crude oil hit the skids again. Here's January crude on the Eagle, and you can see how from Friday's session the market just kept tailing off. So here we are with crude firmly below $40 a barrel again. Who would have ever thought that a year ago? If you had told somebody that crude would be trading below $40 a barrel, they would have laughed in your face. Gold also a little stagnant this morning. Here's gold on the Falcon, and you can see a very condensed sideways range, so we're pretty much stuck here between 1080 and 1078. So about a $10 range there in the gold market. Oh, I said the NASDAQ was looking a little bit more bullish, but no longer. It does look quite a bit bearish now, doesn't it? Okay, so we've got a first micro-macro cross signal going here. Tough one, because where we need to cover the trade, right, in case this develops into a macro pullback signal. And what I'll do is, if it fills, I will cancel the signal and look to place a runner in. And now here we are a little bit higher, back in that macro pullback territory, almost. Technically still a first micro-macro cross signal. Coming back here to test and retest the breakout, which is what we like to see. If the market emerges from a sideways trading range. Okay, now we're definitely into a macro pullback. Okay, I've still just got the single contract on there, so what I'm going to do is I'm going to eliminate my profit target on the off chance this develops into a bit of a trend. Still very early. We're only about 5 minutes into the session. Good morning, Jim. Jim's giving some advanced decline numbers here. We got 600 on the buy and almost 2,000 on the sell, so that's very bearish start to the day. We'll see how that plays out here in a moment. Getting below this low is going to be the big one for the bears here on the NQ. If they can't push it below that low, this trade will very much get back into that trading range. Oops, I guess I need to engage my trigger and Yeah. Well, they came back, tapped the break even. We'll see here in a moment whether or not that was going to be a problem. Do have another chance to enter here, by the way. I would probably take it. Oh, we're so close here with the macro pullback again. All right, let's give it a go. This is a lot riskier now because the market has made this test to the extreme, right? So the chance is that prices will try to go higher from here. And there they go. Now we're into yellow bars. So we can cancel that order. And here we are kind of back within that early morning trading range. All right, here's a green bar sell. Again, a much riskier signal because of this test to the extreme, and one that could quickly develop into a first micro macro cross signal higher, and there we go. So it looks like this breakout was false, and now we're going to be testing the upper end. Oh, we're getting all kinds of mixed signals here this morning. So here we are on the upper end of the trading range, just broke out there, producing another first micro macro cross signal. Looks like we can trail this one down a little. Have to cover it deep to try to get that macro pullback into account. And here we are retesting. Come on, give me my, there we go. So here was the test, the breakout. This is now the retest. We're looking for the buyers to make good on their signs of earlier support. Here too, just like this breakout down here, entering above the high is going to be safer. Entering below the low here was going to be safer. And why the heck not? We'll see if we can't run this one out a little bit. So we're almost at our profit objective. I'm going to, okay, we hit our break-even trigger. Just going to let it flip the, where's my parabolics? There they are. Okay, so we'll go with parabolics. And we, oops, there we go. Shoot, and we got tapped at break even on that one too. The Raptor is producing a cloud crossover signal, getting some support there. Well, we did get some support there. Here we are right back into that sideways range. Okay, well, there you go then. The market is fairly content to bounce back and forth. Here comes a red bar buy signal. This was near the bottom end of the trading range before, and now that's disappeared. odd little morning, but we're only about, oh yeah, I guess we're almost 20 minutes into the session. Advanced decline numbers still favoring the sellers. We got just under 600 buy and 2100 on the sell. Any signal you take while the market is bouncing back and forth like this is going to be pretty risky. Here's a first micro macro cross, so now the sellers are going to give it a go. And you can see that's developing into a macro pullback. Oops. Shoot. I could have tried to sim it on a limit order. That one just got away from me. But you can see the same kind of thing happening as what happened right here, right? We're getting the test of the extreme, although this one not moving higher yet. The sellers are digging in a little bit. All right, there's a macro pullback signal for us. And as I mentioned before, this is all kind of hit and miss until we get outside of this trading range. So if you're looking for a quality signal, this may not be it. Sort of developing into a 4-arrow consolidation also. All right, there's some volume coming in on this bar. That's encouraging. And what I'll do is, just for giggles here, okay, we hit the break even. There we go. All right, and we got the parabolics in play. We would have hit our profit objective, and if we bounce here and tag the break even, I'm going to be a little bit upset. Because we had the profit target on this first micro macro cross. I do believe we had the profit objective on this one also. Yeah, we did. All right, so this one's starting to shape up a little bit better. Sellers starting to take some control. Now we're back here at the low, where we would fully expect the buyers to start to press. Oh, they were. Sellers chewing through some of those orders there, here on the Geiger counter. And you can see the width of the bar. Well, we at least took a little bit out of that one before we got the reversal. But I think I would have still been better off going all in, all out. Yes, I would have. Well, just barely. Kind of tapped us at our target. Into yellow bars now, so we're going to nix that signal. And yeah, just a very choppy day. You can see the trade forecaster here. We're full on in swing mode. Pardon me, scalp mode. Swing mode coming up in about a minute or two. Jim says the Russell's not playing like the rest of them. Okay, we're getting a late filter entry signal now here on the Falcon. This is fairly interesting. I may give up a couple of ticks here to enter below the low rather than right on the hash mark. I know I keep telling you this is a very high quality signal, which it is, but the market's just been so sideways this morning. I think I'll rather give up a couple of ticks and get the later entry. Right, so there's a macro pull, or pardon me, a late filter entry signal. We've got our with trend signal here on the Eagle. Same kind of situation. This is just our regular trend signal. The green bar sell up here was a quality signal as the trend changed. This is our first trend change signal here on the eagle. Also tends to be a high probability signal. You can see the reason for the holdup though, right back here, the overnight lows. Okay, so now that we've tagged the overnight lows, there's hope for the trade, but we do need to get some momentum here. Okay, the Geiger counter, oh, it was chewing through some of the sell orders there for a moment. I'm going to try to keep my stop here above the median line, keep it out of harm's way. Actually, we'll match it with the eagle. There we go. I hate those one tick trends. It's to be expected in a choppy market though, right? If we're in a scalp type environment, we realize we need to keep our stops further back, and most times we'll be better served by taking profit all in, all out. Green bar sell here now on the hawk. Nice thing about the green bar sell is that it's a signal that you can trade either way, right? You can set up for the failure to buy it, or you can short the green bar sell. Normally we short it if there is a defined trend or if we're expecting a test of the extreme. No, I don't want to roll my stops just yet, so we'll hold the stop strategy. Good little move lower, just a few ticks shy of our break-even trigger and our profit objective. There we go, hit the break-even, come on. Come on. Oh, whew. Boy, that was hard work. For a second there, I thought they were going to leave us hanging again. Okay, what I'm going to do here with the Falcon is I'm going to adopt a more aggressive stop strategy also. You could even go with the bar high low. The logic is if the market fails here again, there's a very good chance that it's going to try to run the highs. So I might as well reduce my risk a bit. Same here with the eagle. And I could use something more aggressive still. Perhaps like the bar high low. Let your own risk tolerance be your guide, but do your best not to strangle the trade because we're still only in swing mode. So things could be a little bit choppy still. But if we can press just a little lower here, I'm not looking for a huge move. There we go. Okay, we're about to get down here to 4,700. That was a very significant number last week. Let's see where the primary support is. Primary support 46.92.91-ish. So you could certainly use that as a profit target. The Falcon trade now to break even. And you can see our Eagle trade, that will be our profit objective, somewhere near the primary. And we're doing okay here, just about to hit the break even. Actually, that's close enough for me. Rolled the trade to break even. And again, don't be silly. There's $130, $140 in open profit there. If that's something that you don't want to see disappear, then all you got to do is hit that close button. It's as simple as that. So not a bad morning for the most part. Got some early opportunities there. Yeah, despite the choppiness. Okay, so you see we're getting a little bit of a bullish bar forming here. I'm just going to take the profit. Now, again, I suspect the market will head lower, but why should I let it retreat all the way, possibly hit my break-even trigger? And we'll throw a line in here just to see, my break-even target was right about there. And sometimes you're going to do it too early. Sometimes your timing will be just right. At the end of the day, you have to do what's right for you, right? It's your money, after all. Don't let anybody tell you that you have to have a runner in play, or, that you can't take profit when you have it. All right, you guys, if you excuse me for just a moment, I'm going to be right back. Okay, I'm back. What did I miss? Not a whole lot, and it's starting to look like it was not a bad idea to take the profit while we had it, even though, well, I suppose if I had taken it right on the hash mark, look at that, just kissed the profit target. Just kissed the profit target and then reversed it. Okay, so we'll be looking for an opportunity now to short it again, providing they head lower from here. So selling below the lows is going to be a little bit more high probability, let's say, than trying to sell this green bar sell that we have going on. Okay, and that green bar sell has since removed itself, so no temptation there. Thank goodness. All right, so, well, here we are waiting on them again. And while we're waiting for the next signal, here's a great question from Gary. Gary asks, can you speak to the difference in the Trade Manager and the Trailblazer? Absolutely. Good question, Gary. Okay, the Trade Manager, the key difference, or the two key differences between the Trade Manager and the Trailblazer. The Trade Manager has this risk component built in down here, where it will limit your trade exposure to 2% of your trading capital, or whatever you set it at. 1%, 2%, 5%, 10%, whatever. But it will always contain your risk. So if, for instance, you get a first micro macro cross here and you want to take your signal, it doesn't matter whether you put your stops right here, where we're risking $320, or if we place our stops right down here. I guess I could even stretch it a little further. Right down here, where we're still, well, the idea is that we're still going to be risking about $300. So that's a very cool component of the Trade Manager, is that it has this risk feature built in. So you will never, ever risk more than you can afford to lose. I personally believe that's a very important principle for every trader to adopt. Now, the Trailblazer was developed because some of the Trade Manager owners who were trading some very fast-moving markets had a hard time getting their order in. So, for instance, what would happen is they would say, okay, I want this red bar buy, and by the time, let's say they were picking their targets, by the time they go click, 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 submit, the trade would have already gone past them. So in answer to that problem, the Trailblazer was developed. Now, the feature of the Trailblazer is that it's a one-click system. You preset your quantity and your targets up here. So you need to know roughly what your risk exposure should be. So let's say that you're in a habit of covering above the swing highs. So let's say you know that for your account, if you enter down here and cover up here, you would normally take 2 contracts or 4 contracts or 1 contract, whatever it is that you could afford. So if that's your trading style, then what you want to do is you're going to preset that up here. Now, most times on these types of trades, I'm able to take 2 contracts. So what I've done is I've set up 1 contract with a 15 tick target and the other contract with a runner. See, 0 target there. Now, what that enables me to do is this is now a one-click system. So I'm going to have my stop strategy enabled. And now, here we'll go a little bit further so the stop holds a little bit longer. So now all I need to do is click the sell market button. We don't have a signal here, I'm just demonstrating. I hit the sell market button and you see I have my profit target. I've got my break-even trigger, which happens to be in the same place. And I've got my stop strategy all activated just by clicking one button. Notice I've got 2 contracts in, and when I hit the break even here, it's going to roll both contracts to break even. I took I took profit on 1, and now I have 1 left as a runner. So that's the principal difference, or the 2 differences between the Trailblazer and the Trade Manager. The Trailblazer is more of a one-click system without that automatic risk component built in. And then we've got the Trade Manager that has that risk variable in there, where your risk size will always be this amount right here. If you're trading a market like crude oil or the E-mini or something where, or even the Russell for that matter, where the ticks add up very fast. So let's say here, even the hawk on crude oil. The Trade Manager is very helpful because let's say I was looking at a trade like this, and let's say I wanted to cover above here. Oh, see that? Trade Manager says, sorry, Eric, for your account size, you can't afford that. But, you know, what if I chose to frame it here? Okay, Trade Manager would say, all right, $300, you can afford to lose that money without wiping yourself out. With the Trailblazer, it would allow you to place a stop up here. And if you were taking 2 contracts, you may well be risking more than you can afford. So that's a very, very important concept with the Trailblazer. If you're going to be using that tool, you don't want to overextend yourself risk-wise. Generally speaking, 5% or less of your trading capital is considered prudent. If you can keep your risk to that amount, you'll probably come out on top. The advanced decline numbers still favoring the sellers, 500 on the buy, 2,300 on the sell, and yet the market very reluctant, it seems, to be heading lower. Okay, got a macro pullback signal here. We did get a couple of good signals while I was speaking. We had, we had the Eagle produce a with trend signal right here, and we also had the Raptor produce a double pullback signal right here. So the double pullback occurs, we go into the hard edge twice, coming out of the hard edge, producing a signal. These lows now seem to be the real stumbling block. So this whole 46.92 area, which of course is where the primary support is at. If we take a look at our support and resistance suite, oh, look at that, 46.92. Primary support. So it looks as though the eagle would have eventually drifted down there to our profit target after a little bit of coaxing. Looking at the hawk to perhaps produce a 4-arrow consolidation, or this next hawk signal you could consider to be a first micro-macro cross. Even though the micro line and macro line haven't crossed, you'll notice everything has gone out of sync. The bars have gone out of sync, the trend lines have gone out of sync, the filter has gone out of sync. If we produce another signal here, you could consider that a first micro-macro cross signal. The Falcon also producing a late filter entry signal, which I'm going to simulate here. I'm going to get up there. I'm going to see if I can't simulate that entry on the hash mark. There we go. I don't normally suggest this type of strategy to go back and chase the market a bit, but I'll make an exception this time. And we'll see whether this late filter entry doesn't play out. So the late filter entry quite simply is when the trend line does not change color, but the filter does. The filter goes out of sync, and then very important, it has to come back into sync. If it doesn't come into sync, it's not a late filter entry signal. Come on, just give it a little bit of a push. Get below that primary. Get below the primary support, and I think we're going to be okay. There we go. Come on, just a little more. There we go, just about to kiss the break-even target. Okay, we're playing with their dime now. There we go. Get down there. Oh, you stinkers. Get down there. Oh, man. Oh, well. A little bit of choppiness still. It's to be expected. We're still only in swing mode. Trend mode coming up in 15 minutes time. We'll see if that doesn't have a little bit more follow through to it for us. They're trying. They really are. But every time they dip down here, they get knocked back a little bit. I'm not liking that. Okay, so our hawk here, that was that first micro macro cross I was telling you about. That developed, hit its profit target. Here we are now with a macro pullback right back in the same area. So looking for sellers to recommit to shorting that same number that they did before as we try to inch our way down to, I would say, 46.80. This, a lower probability trade, even though it's a macro pullback signal, you can tell the market really struggling at this level. The buyers won that bar. Now we're into yellow bars, so I'm going to cancel this order. There was a chance that if the sellers took this bar, we would see it press lower still. And now here we are with a green bar sell. None of these signals giving me a real warm, fuzzy kind of feeling. I see the sellers give it one more go here in a moment, I think. Buyers having their kick at the cat. Tony says he's been getting better results on the Hawk using a 10-tick trade. Seems to move 10, then reversing. Yeah, sometimes we need to adjust our profit targets and our stops given the current market environment. Anytime you take a profit, though, it's not a bad thing. Even if you find yourself getting out too early, maybe the next time you'll be able to leave a runner in play. Okay, the buyers and sellers very tight right now. You can see we've got this little bit of a range developing again. Skewered by the 10 a.m. low. All right, so the Raptor here producing a buy signal. You can't see it very well because it's right on the hard edge. Oops. We'll see if we can't take this one on a second push. This is the other way that you can enter with the Raptor is you right click on your chart and you place your order. Now it's important to remember that when you do that, your orders are live the moment you put them on your chart. So what I have a tendency to do is I'll place the order up here somewhere and then I'll try to drag it in to where I would like it to be. So not the highest probability trade here, but we might see a little bit of a uptick as the market tries to test the upper end of this trading range. We have had a little bit of a test at the extreme here, a little bit of a swing, but for the most part, the trend is still down today. I guess I better get a stop strategy in play here. So this is definitely a counter trend type position. But maybe we can take advantage of a quick little move here to the upside. And the signal itself developed here at the hard edge. I was just a little bit late getting to it. Come on, get up there. Lawrence is asking, can you add the features of the trade manager to the Trailblazer? Well, then you would have the trade manager. You can still enter with your buy and sell market buttons with the trade manager. You preset your quantities up here. So let's say you're always going to take 2 contracts, and you see if I have a stop enabled, if I hit the buy market button, and I click, oh, it didn't give me my stop. Hold on a second here. We'll see once this bar closes if I get my stop. It's supposed to give me my, no, it didn't give me my stop. What's up with that? Do I manually have to set a stop? Yes, I guess I manually need to set my stop in this situation. There was a way to do it though. I forget. Hold on, it'll come to me. But like I said, you can still use your buy, sell market buttons here. And you can preset your quantity and even your stop limit ticks, so how much slippage you're prepared to accept. That's what that feature is. Yeah, because of the one-click feature of entering the trade, and I'm going to take this to break even now. Because of the one-click feature of the entering the trade, it's impossible for the programming to calculate your risk exposure. Because your risk exposure will always be based on where your stop is at. And they're going to tap me at break even. So it came up just a little bit short of the profit objective here, but that was due to my late entry. All right, so here come the sellers once again. We're producing a green bar sell here on the Eagle. Not currently against the ATR, however. The ATR is this squiggly red and blue line that we have on here. So we'll use that as a filter and let the market come around to our way of thinking before we commit to a sell. All right, here they go. So working on a red bar buy signal here on the hawk. Because the trend seems to me to be more down today than up, I'm going to look to short it. Short the failure of the signal. And kind of basing that on, what I'm seeing here on the eagle, which seems to be down. And remember, you don't need to sell a red bar buy signal. You can simply use it as an early warning that a failure there could develop into a first micro macro cross lower. In fact, it will almost always develop into a first micro macro cross lower. All right, well, we're sweating the market here for a moment. Kai asks, what is recommended in the case of money management? 1, enlarging the stop for a single contract when the account is growing for having more possibilities to enter reasonable trades. Or 2, is it recommended to double the number of contracts and keep the stop loss in a predefined maximum distance to the entry point? Very good question. The whole logic behind keeping a wider stop is to keep yourself from getting stopped out prematurely. Now, this is something that I tend to lean toward. You're going to hear other traders tell you that it's foolish to run a very wide stop. You should always keep your stops tight. You should always keep a 2-to-1 reward to risk or 3-to-1 reward to risk type ratio. And I understand the logic behind that. To me, it's logic that works on paper, but not necessarily works in the real world. So for me, my objective for using a stop loss is this is my safety net. This is an amount that, although it would be unpleasant, is an amount that I can afford to lose. My objective is not to use my safety net. just like a tightrope walker or a trapeze artist. It's there if you need it, but that's not the objective, right? The objective is to have a profitable trade. So to that end, I want to increase my probabilities as much as possible. I believe it's sound to run a wider stop initially on a single contract in hopes of hitting your profit objective. Most times the market will give you at least one chance to adjust your stop if you're wrong. So let's say, here, we're going to cancel this so I can show you. But let's say we looked at this macro pullback signal here, and let's say we chose to take it on the hash mark. So there's our signal. We're going to take it on the hash mark, and now we want to run a reasonable stop. So at the very least, we're going to run a stop to here, right? But let's say you want to be ultra conservative and you're going to run your stop up here. Let's say you could afford this risk. One contract, very wide stop. Market brings you in and immediately starts going against you. Well, somewhere through here, the market will give you at least a chance to adjust your stop, providing you're paying attention. On the very rare occasion, the market will make a beeline to your stop loss and you won't have a choice, but get stopped out for the full amount. So here, right here, the market has given you an opportunity to say, okay, this is where the sellers are going to recommit to the market. Now you have an opportunity to start adjusting your stops. And how aggressively you want to roll them is up to you. A lot of times I'll go with something like the bar high low strategy, and I'll stay 2 bars back, or if I'm really hesitant about the trade, I'll roll it bar for bar. The point is that when the market does reverse and stop you out, either here or the next bar or next couple of bars, you have effectively lessened your risk by half. Right? So you didn't take the full 200 stop. You may have been stopped for 100, or if you were more efficient with rolling your stop, you might have been stopped even here at about an $80 loss. But the point I'm trying to make is that even though we had a great big stop to start, we didn't need it, right? We had a chance to adjust our stop to a more reasonable number. So that's one reason I like to use a wider stop, because I have that luxury of rolling my stop in when the market gives me the cue that, okay, Eric, things might not be working out as planned. Do something with your stop. The other method that you're referring to is taking more contracts by using a predefined stop or a predefined distance is also a good strategy, because of course you can increase your earning potential with the 2 contracts. The problem is you're going to be stopped more frequently. Now I'm assuming when you're saying a predefined distance, it's a predefined distance based on how much you can actually afford to lose. So let's say you can afford to lose $300 and you're going to take 2 contracts. Well, that means your risk is always going to be just 2 stops or $150 per contract away, right? 150 times 2 is $300. Will that be enough to keep you out of harm's way most of the time? It's hard to say, but a tool like the Day Ranger here would be helpful in that respect, because you can adjust your stops given the market's volatility. So you can see the average daily range here for 30 days was 215 ticks, 112 for your 10-day average, 313 for your 5-day average. The market's kind of flopping around a bit. It actually looks like the ranges are expanding somewhat. So if you looked at this and you said, okay, well, let's call the average 200 to be conservative. The average daily range is going to be 200 ticks. And let's say you wanted to offer up 10% of that as a stop loss, well, then you would have a 20-tick stop. And that would keep you out of 10% of the market's range, which is usually adequate. Anywhere from 10 to 20% is usually a pretty adequate stop for most swings. So, I don't know, Kai, if that's helping you a whole lot. I suppose you got to go with the one that makes you the most comfortable. And remember, your stop loss is only there as a safety net, right? It's not there for any other purpose than to keep you from blowing yourself up. If you take enough of these onesie trades, your account will add up fast enough, right? If you're hitting the onesie trades, here, we'll do it like this. If you're hitting the onesie trades all the time, you know, taking the high probability signal, hitting the onesies, you know the math. Two $50 trades a day over the year, you'll make $20,000. So if you're starting with a small account, let's say you're trading a $10,000 account. I don't know how much you're trading, but let's say you're trading a smaller account. You're starting with $10,000. If you can do this, well, in theory, by the end of the year, you'll have a $30,000 account. Well, now all of a sudden, you know, you're getting a little bit more clout. Even if you did it for another year, you'd have a $50,000 account. Now, I know 2 years seems like a long time. We all want to, you know, start making the payments on our Ferrari tomorrow. But if you had like a 5-year plan and said, okay, this is my objective for the first year, this is my objective for the second year, really in 5 years, there's no reason that you couldn't be in a position to be trading a 70, 80, maybe even $100,000 account. Starting, you know, today with a $10,000 account. That is not out of the realm of possibility, not by a long shot. But it's a very interesting question, and unfortunately not one that has an easy answer. The way I'm wired, few things bother me more than a premature stop out. And you might think that's funny because you guys have all seen me tweak myself out of a perfectly good trade, right? That's my nemesis. Taking myself out of a profitable trade too early. But that's, you know, that's something that I have to deal with. That's my cross to bear. Yours is going to be different. You know, maybe yours is over trading. Maybe, you know, you're looking for too many opportunities. You're trying to get into the market too often. We all have our little quirks and idiosyncrasies, right? One thing about trading is it will ferret them out. You will know what you're good at and what you're not so good at. And I'm not saying this in a negative fashion. You will know beyond a shadow of a doubt what your risk tolerances are. Yeah, I think you're on the right track. Kai says here, I have to think about it a little bit more, but I'm sure that the rules of the trade manager and its money management is a good beginning. It definitely is. Some of you will have heard me mention Derek in the past. Derek is kind of like our poster child trader. He went from being a onesie-twosie trader. He traded for a couple of years this way, never really making any money. You know, making a little, losing a little. Then he got the DTS system. He got the trade manager. And all of a sudden, his trading started to get some traction because instead of just taking a onesie-twosie trade, now all of a sudden he was in a position where he would take, oops, sorry, I'm still on the manual mode. He would take a trade and it would offer up two contracts. Oh, sorry, I'm still in onesie-twosie mode. Here we go. He would be taking 4 contracts or 3 contracts or whatever it was that his account would allow. And now all of a sudden his account started growing and he started really making some money. Well, that's because he was correctly capitalizing his positions. You see, what most people do is they lose big and they win small. I'll let you think about that for a moment, because what most people do is they'll say, "Oh, I'm just a small trader. I'm going to be very careful. I'm only going to take 3 contracts on every trade." And it's kind of hard here to show with DTS because the signals are usually carry a lot of momentum with them. But let's say we take this signal down here, which is not our signal. But this is what most people do, is they keep their stop very, very tight, and then the market brings them in and stops them out. And all of a sudden they've taken a $200 hit. So then the next time they say, "Oh, my stop was too tight, I'm going to keep my stop further back." So now they're risking $300 and the market comes in and takes them out, and now they're 500 in the hole. And then what they do is they say, "Oh, well, the market's not cooperating today. I'd better only take 1 contract." So then they take 1 contract and they set up their trade, and they frame it whatever like this, and that's the time that the bottom falls out of the market, and they would have made all their losses back and then some had they correctly capitalized themselves. Had they stayed with their 3 contracts, they could have well made $1,000 on the next move lower, recovering their $500 in losses and putting another $500 in their account. But in this case, they make the whole $50. So instead of losing $500, they lose $450. Right? And they walk away at the end of the day still in the red, and they're left scratching their head wondering why. What am I doing wrong? Well, you're losing big and you're winning small. Trade Manager prevents you from losing big by always limiting your risk. Now, I've set it at 2%. If that seems too high to you, set it at 1%. Oops. Set it at 1% or 1.5%. It depends on your account. Some of you will have heard me mention I was doing some work with a trader. He was trading a $300,000 account. Well, there's no way we had to risk 2% or even 1% of his trading capital. We were risking 0.25%, and he was still trading huge. In fact, if he had gone in with a full 2%, he would have slipped the market, trying to get 20 or 30 orders filled. We would have had to start off trading a market like the E-mini or something that's got super liquidity to it, so that he wouldn't get slipped on his fills. Okay, Gary asked, Eric, I just purchased the Raptor system and I'm curious how I can get my Omni timer to look like yours. Well, Gary, you're going to have to get the Geiger counter. The Omni timer is the timing tool, and it's very helpful. I don't usually put it on here, but we'll put it on so that you can see the differences. So there's the Omni timer. This is the Geiger counter. There is a smaller version of the Omni timer as well. And the Omni timer will either track in time, or right now it's tracking in, oh, it's not tracking at all. Let's see if it allows me to do that. There we go. So it's tracking the bar development relative to the others, and it's going to tell me whether the bar is especially fast or especially slow. The Geiger counter, on the other hand, is the tool that measures the order flow. So it's a representation of our time and sales. So you'll see here, print the histogram in just a moment. I'm just going to get rid of the Geiger counter there. The histogram here is going to be a history of the time and sales. And what we are typically looking for on the histogram are spikes in the buying and selling, which are sometimes an early clue to a pending reversal. The dial is very helpful around the Geiger counter, because if the dial pulls over hard to one side and stays there for several seconds, we can see that the buyers or sellers are starting to chew through those orders, and very often we'll see the market move in that direction. So you kind of get an early warning. But watch it here for just a moment. You see how it's holding and holding and holding here on the buy side? That's a pretty clear indication that we're going to see a little bit of an uptick in prices. And what happens is, if you're in a trade or thinking about taking a trade, the Geiger counter can be very helpful in this respect. See how it keeps pulling and holding? We're almost sure to see a little bit of an uptick here. And it will happen a few seconds before the market actually moves. So sometimes you'll have a chance to actually get a trade on. But let's say we were short here from the Raptor. Let's say we shorted this signal here, and now we're watching the Geiger counter, and we keep seeing the Geiger counter pull hard over and hold on the buy side, and we're short. We might think, okay, if my stop was currently up here, we might think, okay, it might be a good time to start rolling that stop in case the market reverses. I want to minimize my risk exposure. So I could be a little bit more aggressive with my stop, thinking that the market might start to move against me. And we'll just stay with this for a little bit so we can see if, in fact, we do get that little bit of an uptick. So the Geiger counter, a very helpful tool, I think. It's the latest tool from Indicator Warehouse. It's a great tool for judging, like I said, the buying and the selling efforts. See, we're producing a sell signal here, but the sellers are coming back a little bit. Yeah, see how the buyers are pulling it over and holding it? I think this support is going to hold. I think we could see a little bit of an uptick. Now, the Geiger counter can be used on any of the tools. I just happen to have the tool assortment the way I do, to feature one tool per bird, so that my charts don't get too cluttered. It's more really for your benefit, so you guys can actually see what's going on the screen here. let's see what they do. Oh, Jim got himself caught on the wrong side of a counter trend trade. The ticks went to a negative 1,000. Jim's also watching the New York Stock Exchange ticks, and they went to a negative 1,000, which tends to be bullish. That's a huge move lower on the tick meter. And Jim went long at 61, he says. So let's take a look here. He's long on the YM, bought in at 61, taking a little bit of heat on the trade. So we'll watch the Geiger counter here for a moment. The buyers are chewing through some of those orders there. That was a pretty good pull and hold. That's what we want to see. We want to see that Geiger counter roll around. Now it's chewing through some of the sell orders, which is not so good for Jim. Counter trend trades tend to be more viable when you've had a test of the extreme. When you've had that little itty bitty hiccup, where the market does one of those, that tends to make for a more viable test or counter trend type trade. Well, you're in at a tough spot here, Jim. The buyers and sellers are taking their turns, waffling the market back and forth. Uh-oh. Okay, here we won't watch. All right, we'll put that away. Yeah, just a real tough zone that we're in right now. A little first micro macro cross signal right here. Looks like that one hit his profit target. The eagle with a with trend signal here again. The market really taking its time committing to a trend this morning. Gold prices tailed off a little bit, as did crude oil. We haven't really been looking at those very much today. Floyd asks, do I know why they might be so choppy today? No, not really, Floyd. Let me just see if there's any reports or something due out. No, I don't see anything that looks to be influential today. Could just be that they're content where they are price-wise. Yeah, that could be it too. Tony says the volume is very light. He says very thin today. The NQ is only at 100,000 and the Russell is only at 36,000. So yeah, if there's not a whole lot of market participation, that could account for the sluggishness also. We have been paying off to the short side, so that is my personal preference at the moment. Not looking to short in a big way. Every time I try to short the NQ huge, it turns around and spanks me hard. And I don't like that. I wouldn't be surprised to see I wouldn't be surprised to see the market drift a little bit. Maybe to the 46.60 area even. That's still 20 points below us. That would be close to our next support line. Well, actually 46.70 would be closer. Oh, they're trying. This is why you need to trade with risk capital. Because when the market acts like this, it's always hard to keep your composure. So we're getting a couple signals here. If you're looking for a chance to sell, here's one on the Raptor, which we could short. The problem with the trade is where do we cover it? You could cover it above the swing high, which is, oop, that's not far enough. Let's try making that a little stronger. There we go. Trying to keep it out of harm's way because we have been kind of drifting sideways here. You know, we don't want to let the market reach too far back. Tony says for him today, every loss has been a counter trend trade. Funny how that happens, isn't it? And I don't mean funny, haha. And oh, you're not alone, my friend. I've had those days too where sometimes your eye just won't pick up the trend. You just won't see it. And you know, I can be a little thick at times, as my wife will tell you, and I'll just end up trying to buy into an obvious downtrend. That's why on my trading journal sometimes you'll see these great big stars and circles when I'm trading against an obvious trend. All right. Okay, well, we're at the top of the hour. So I think we're going to button up the room here for today. Just a reminder that this is our last week in the trading room before the Christmas break. The end of the week, I'm going to be taking a couple of weeks off, and we'll resume again in the new year. But if you're going to continue to trade this afternoon, I think, you would be better off looking for selling opportunities than for buying opportunities. Even though right now we're seeing a little bit of a retracement, I'm not sure that the market is going to press too much higher today. But we'll see how the day unfolds. All right, you guys, catch you again tomorrow. Bye for now.